All right. Let me make sure no one else has emailed me any questions. We're gonna get started. Francis, you were here first. You were talking about LIFO, FIFO. So we're gonna focus on doing a LIFO, FIFO problem just to kind of get the gears going. And then we'll just go down the line. Jacqueline was here next. She's on Zoom. So she'll get to pick the next topic and we'll just keep going from there. I forget who came in after, so we'll just start popcorning. All right. Woo. So there we go. So FIFO, FIFO, you guys remember, we dealt with log purchases. What do you focus on first with FIFO? What does FIFO mean?
First in, first out.
Mhm.
Yeah, I forgot those were days. I was like, oh no, it's fractions.
Yeah, let's get your fractions ready. As we've always done in accounting. I get the bare bone structure of one of these guys out for y'all. Okay, there we go. I'm gonna give you guys 5 minutes.
It was FIFO maybe?
We're using LIFO. If you're using LIFO already, keep using LIFO. That's a good question that I should have put on the board when I started. Sorry about that.
Yeah, that makes sense.
We'll do them as both either way. So once you're done doing, whether if you're doing FIFO or LIFO, after you finish, do the opposite one. And we're just run through both of them at the same time.
If we get the FIFO one done, we start on LIFO.
Yep, just start online. We're gonna go through both of them either way. That's where all the fun terminology comes into play.
Alright. I apologize in advance for my big hand.
I'm gonna give you guys 3 more minutes and we're just gonna run through both of these. We got a sign-in sheet. There's a sign-in sheet. Oh, no. Oh, okay. Otherwise, we're working on like the FIFO, we're just about to do the invoice. All right, let's get started. Y'all want to do FIFO or LIFO first? FIFO. Got first in the name. Things we have to keep in mind, I'm gonna put this down here for both of them. We want to make sure we have the revenue. We want to know our cost of goods sold. We want our, and at the end of it, we want our gross profit. So, January 1st, what happened? What would we do January 1st?
Bought 10 units at
Bought.
5.
About 10 units. At 5. Anything going in my cost of goods sold?
No.
Nope. What about the ending inventory? What's it gonna say now? And at 5. January 20th. What happened? Which is 28. Got 20, oh, sorry. Equals 96. Anything happening in cost of goods sold? Nope. And what's our ending inventory looking like?
10 units at 5, 12 at 8.
Perfect. All right, January 31st, something new happens. We sold 14 units, $20 per unit. So anything happening in our purchases? What was it? No. Nope. Perfect. Anything happening in our cost of goods sold?
Yeah,
What's happening?
so we have 10 at 5 and we have 4 at 8. And that's because we're taking like 14 of them, so we have to do first in, first out. So the first one on inventory gets taken out, and then we take a little bit from the second one.
Perfect. Anyone confused with that step, or do we all kind of understand that? First in, first out, we're taking first inventory we bought. And once we're done with that, we go to the next. So what's our ending inventory looking like?
8 units at 8.
8 units a day. And perfect. Awesome. February 5th now. Purchase 9 units, $10 per unit. We'll put in the purchase column. Nine. Perfect. Anything happening in cost of goods sold? No. What's our ending inventory looking like? 8 at 8 and then 9 at 10. Perfect. And then last day, February 10th. We sold 10 units at $20 per unit.
NA purchased. Then 8 units at 8, 2 units at 10.
What's our ending inventory?
7 to 10.
So if you're asked how much is your ending inventory, what would you say?
70.
Perfect. This is basically the ending inventory after every is done with. Now let's go over to revenues. How are we gonna figure out our revenues?
I don't remember.
So, how many units did we sell?
34.
34?
Wait, I'm sorry, 24.
24, perfect. For how much? $10. Did we get $10 when we sold them? How much money did we get when we sold them?
What do you?
20. If you look up here, this number here is your revenue. Basically, for each unit that we handed them, they gave us $20.
Okay.
Which equals 40. How about our cost of goods sold? How are we finding our cost of goods sold?
Yeah, add up like the cost of goods sold, maybe.
So which number?
So like 50 and 32 and 64 and 20.
Perfect. So I pre-did that a little bit. So 84 plus 82, 166. Now, how do we find out our gross profit?
480 minus 166.
480 minus 166. $314. So, any questions on FIFO? You feel good on this? All right. Let's go on to LIFO now. January 1st, what happens in LIFO? Anything different? No. Nope. 10 units at 5. I've given up on the at symbol, so I'm swapping over to an X, so that's why it's different. Nothing special.
It's just notation after all.
What about January 20th? Anything different? Nope. All right, what about January 31st? Anything different?
Yeah, the direction in which like you sell it is different.
Mm-hmm.
So like I put that we sold 12 times 8 and then 2 times 5.
Perfect. 12 times 8. 5. That equals 14 units sold.
Yes.
6 here. 106. What about our ending inventory? What's it looking like?
8 times 5.
8 times what? So then we have February 5th. Anything different? No. Nope. Same old, same old. Last day, February 10th. What's happening there? What numbers we using? At 10. And at 10. One at 5. What's our ending inventory looking like? 7 at 5. At 5. Perfect. So. This time we got things a little backwards. We have, instead of first and first out, we're using LIFO, which is last in, first out. Which is why we're taking the last thing we bought. So to kind of put these two side by side. How much revenue are we making? Does that change? Nope, revenue stays the same. What about cost of goods sold? Is that changing? Why not? So we're using 106.95, which is the one. And gross profit. How much is that?
279.
279. Now we're getting into the theoretics. Any questions before we get into the theoretics? Yes.
Explain like the most of the steps again.
Yeah.
Like, yeah, the 12 by 8 and the 2 by. Like I get to take this stuff, can you like, explain
Yeah, the cost of good or the gross profit part.
just that confidence, like, I went on that grid.
So we find these numbers from using last and last out. So we know we sold 14 units. So we have to take from this supply first, which is why we take 12 whole units, multiply it by 96. You then take 2, so 10 minus 2. You get here.
Okay, got it.
And then again, you multiply 2 times 5, add them together, that's how you get that 106.
Sounds good. I was just forgetting how you move it over. I get it now. Thank you.
Be consistent. Yeah. Any other questions before we get into theoretics?
I have a question.
Awesome. So the theories with a lot of these inventory methods is typically what the valuation of inventory. So it's always figuring out what the value is. And first in, first out, you can see that our gross profit is higher than LIFO. And the reason why is because since we're recording that we sell the cheapest inventory first, in times of rising cost, FIFO has better revenue. But LIFO, on the other hand, has lower revenue. This is where we get the LIFO conformity rule, because if we're doing taxes, we want to show that we made nothing, because otherwise you get a lot of taxes. So a lot of companies will choose LIFO, and if they have to use it for taxes, you have to also use it for your financial records, such as the LIFO conformity rule. And that's because in times of rising costs, you can see $10 is more than $8 is more than $5. So we're axing out the $10, axing out the 8. And as you see here, we still have the $5 units. While over here, we got rid of those a long time ago, and we have the $10 units. Now, there were other methods you guys used, but you did not have to do them. But things just to know, weighted average. It kind of, it flattens the curve. So instead of having all of these high numbers of gross profit and stuff, it's kind of like we're smoothing things out so they're consistently the same. We're getting the average. And then specific identification. Is where you have very specialized inventory. So because we have these specialized inventory, think of car salespeople. they're not gonna lump all of the cost of cars together. You have cars that are worth at least 50 grand, you have cars that are worth less than 10 grand. So instead, that ticket price that they put them underneath is a specific cost of goods sold that they bought it for, that they keep recorded in their books. So things like that, things like jewelry. So with these two methods, that's kind of the idea for them, for the theories. Any questions? Nope. Awesome. So Jacqueline, I said you're next. You're on the Zoom call. So let me know what you want to work on next, or we're gonna popcorn it around to the public.
I don't really have anything like specifically in mind. I kind of just need to like go over everything. So if anyone else has other questions.
If no one else has other questions, we'll actually start going through the review one by one, but I want to really focus on where people feel they have issues the most. So I'm gonna leave it open to the room. Any chapters you guys want to look back on, anything? Chapter 7 again? No worries.
Oh man, we have not done that in a long time.
Oh yeah, chapter 7 is the hard-hitting chapter that everyone hates. I think 1 out of 20 people actually like doing it.
It's like, I enjoyed it a little when we first did it, and then I was like, I'm never gonna know this again. It's gonna come back to bite.
It was great because this semester, when we were working through it in the chapter at work, I actually got given a bad debt project, so I got to use all that fun stuff.
What chapter is LIFO and FIFO from?
Chapter 5. All right, so I'm going to, just like I did before, I'm gonna throw a problem at y'all. I'll give you guys 5 minutes to work through it. And then we're gonna talk about the theories behind it and why we're doing what we're doing.
Sorry, did you say this was chapter 7?
Yeah, this is chapter 7.
Okay, thank you.
No, no me mueras. Espera.
No te muerde, te lo juro.
No, 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 no,
Ven, Pinks, ven.
espérame. Espérame, No, espérame. No es que
Mira, no hace nada. Mira, mírame, mírame.
no.
Mira, mira cómo se lo pasa por toda la cara. Mira,
No,
por el
no.
cuerpo. Arriba, abajo.
Gemini, we can hear you.
Mira cómo está.
Mira. De mi mano se lo come. Ay, bueno, me lo arrancó. Pero se lo puedo quitar, ¿ya
ves, se lo
viste?
arrancó.
Pues porque jala fuerte.
Bueno, baja.
Comes up. I shorthanded ADA just so I can get the question on the board, but ADA is our allowance. Or doubtful. I'm gonna give you guys 5 minutes to go through this, get your adjusting journal entry, and then find your net realizable value. And then after, we're gonna work on it and talk about it. Is everyone, oh, I see what's happening. There we go. That could be easier to see.
I got a question.
Yes.
So like for total AR, if we were to put that like on a T chart, is what we have like a debit or a credit? I'm not remembering.
What, account receivable, what normal balance does it have?
Oh, oh my goodness. My brain died there.
Oh, it's all good.
Okay.
That's why you ask questions. It's always good to ask questions.
Oh my goodness.
Right, I'm gonna give you guys one more minute and then we're gonna start working through this. Let's get through this. So. Does anybody have the journal entry?
Mm-mm.
Nope. Do you guys remember what the debit is for adjusting for bad debt.
Oh, bad debt expense. Oh my goodness, that's the account that I forgot about.
Bad debt expense. Do we debit or credit it?
Maybe debit, I'm not really sure.
What's a good sign that it's a debit?
It's an expense. That's why I thought it was debit. I
Exactly.
was doing a wild guess there.
Right here, expense. But now you guys should know, expenses are technically almost always debit. Awesome. I'm gonna get,
I was just like, there's some account that I'm missing. I don't know what it is. And like, I didn't take my notes today, so like.
you're all
get off
good.
my mind.
So what's gonna be our credit? So if we know bad debt expenses are debit, what's gonna be our credit? Allowance for doubtful accounts.
Since he's a good on credit, so actually works.
So does anybody have the amount that we're going to be using for it?
Is it gonna be like 7,000 or something?
Not 7,000, so you're right, the steps for it is, we got 10% of AR, which that is 7,000, but the thing about it is, that 7,000. Down here. That's what we wanted at, that's our target. So, for our ADA T-chart, what else do we have to do?
Well, we have to show how we got there.
So what's our starting point?
400.
Perfect, 400 credit. So what does that mean? What's the amount that we're putting out there?
6,600.
600. So this has to become a reality, meaning we have to make a journal entry. And that's where this comes into play. Adjust. Now, what is our net realizable value? Does anybody remember the steps for that? Do you guys remember how to find book value for the book value for a asset?
What it was priced at originally,
What it was priced at? What's next?
then tracked, which you paid for, or
Not exactly. So we're talking about, we're taking a step away from AR. They go together. So we're looking at the not bad debt, book value. So you're right, whatever we paid for that equipment, what is it subtracted by to find that book value?
salvage.
Not the salvage value. You're thinking of finding depreciation
Yeah.
expense. So book value is your cost minus. What do we do throughout the year? What's it mean whenever we drive a car off the lot? Depreciation, but what kind? Accumulated depreciation. So to find book value, you take the cost of the equipment, the historic cost minus cumulative depreciation, equaling that book value. Now, it's similar for net realizable value. NRV is minus our allowance for doubtful accounts. So in this case, it's 70,000 minus 7,000. So that then at the end of the day, our net realizable value for account receivable is 63,000. Now, to balance off that, I know I didn't put it here, but we're gonna work on a little bit of a write-off. We're gonna say, all right, Joe Schmo had to have his account written off. Or we'll say grand. Not a great number, but we have to deal with it. So what's the journal entry for writing off a account? I do have the chat box on Zoom up as well, because I saw Gemini put up that answer for a previous question. So if y'all want to utilize that on Zoom, feel free. Participation from all corners as well. So what's going to be our debit? So are we increasing our account receivable or decreasing it? Because account receivable has a normal debit balance. So if we're writing off an account, does that mean we're putting more into the account or taking it out? Taken out. So account receivable is in here, but it's gonna be our credit. What are we debiting? Not bad debt expense, that's for a direct write-off. Allowance for doubtful accounts. The reason why we don't do bad debt expense is because we've already done it here. This is our year-end adjusting entries, now that you guys have worked with the chapter 3. This is very similar to every other adjusting entry you guys have worked with, where we're making adjustments of the year. So that's the only time we'll touch bad debt expense. Every other time, we're gonna be fully involved with allowance for doubtful accounts and account receivable. So 1,000. So we're gonna put this on key charts. ADA was 7,000. 6,000. Then we have account receivable. All right, so working off this. What's gonna be our net realizable value? Well, what's our account receivable balance now? 69,000. What's our allowance for doubtful accounts?
6,000.
6,000. So what's our net realizable value?
30,000.
Where is this familiar?
Net income statement. No. I don't know. Never mind.
But where have we seen 63,000 before?
Oh. In the.
Yep. Right here. This is why this method, it sucks, but in all honesty, it's great. It's great in the business world. Because no matter what, our net realizable value doesn't change. We're always gonna be at 63,000 because we don't touch our bad debt anymore. It's gone. Does that make sense? Any questions on this?
What was this one? The right. Like this is the write-off.
This is a write.
I kind of forgot. Where did we get the 6,600 from?
This is 6. That's gonna be from, we started off at 400 because we had a normal we had a balance of 400 credit in our ADA. So that's where that 400 came from. 7,000 came from 10%
Oh.
of 70,000.
Okay.
And then we just filled in the blanks. So any other questions for this one? Or is it kind of making sense?
Kind of making sense. Let me take a picture of what's up there real quick.
You're good. I'm also recording this, so as long as Zoom has not messed up this recording, it shall be posted on the YouTubes.
I don't take chances.
And I completely understand. So we're feeling good on this. What's another thing you guys want to practice on? Y'all want me to pull up the final study guide list and we'll pick a thing?
Yes.
Yes.
I think I have another one.
What other one might you have?
So I feel like we didn't get much time to go over chapter 12 because it kind of was just, it was so fast. And by the time that we were taught chapter 12, like there was a million other things to do. So it was like, I don't know.
We can run through chapter 12 real fast, but I will say chapter 12 is not gonna be the biggest thing on your test.
Okay,
But has some design sheet. Thank you.
very good point.
The biggest thing, and we'll go over it real fast, we'll go over it. Let's gonna get this ready. We'll go over chapter 12 a little bit and then we're gonna go over the final exam. All right. Then going over chapter 12. The biggest thing you guys really have to understand is the difference between operating, investing, and financial activities. So. And I think it was practice in the chapter 12 notes where you guys actually go through like different scenarios. But just kind of to give a short overview of operate, where do you think you're going to be finding that? So operating is going to be found mostly in your income statement. So anything dealing with your expenses, your revenues. And your current liabilities and assets. Operating is kind of just keeping track, okay, what's happening within the operating standpoints. When our account receivable account goes up, we say our cash went down. Because if you think about it, when one asset goes up, one asset has to go down. And this whole thing, the whole cash flow statement is literally just focused on cash. That's why in the Connect problems you guys had, a lot of the answers was just purely based on the money that was passed. We don't care about gains, we don't care about losses. We don't care about depreciation expense. We only care about the money. Investing activities are our long-term assets. Those are the things that we invest in. We put money into these equipment we want to last. So. Then financing is purely based on our long-term liabilities. And our equity. These are what are financing our activities. Whenever we're thinking about, okay, people bought into our common stock, they paid us for common stock. When equity goes up, assets go up. Same thing with long-term liabilities. When long-term liabilities or short-term liabilities go up, our assets also go up. Because if you think about it, A equals L plus E. If a liability goes up, assets have to go up. Otherwise, everything is mute and the formula is broken and all the accountants are running around like there's fire. We don't want this formula to go bad. That's also why when assets go up, assets go down. If we're just purely talking about a transaction that focuses on assets going up and down. If equity goes down, assets have to go down again. We're balancing each other out, whatever makes it balance. So if you think about it and you're looking at these and it says, okay, inventory increase, what does that mean for cash? If inventory increases, what does cash do?
Goes down.
Goes down. And would that be operating, investing, or financing?
Operating.
Operating. Red. We bought equipment. Is that operating, investing, or financing? Investing. So equipment goes up, what does cash do? Huh? Cash goes down. We paid off our bond payable. Our bond payable is gone. We gave it away. Well, we paid it off. We were good bond owners. So is that operating, investing, or financing? Financing. Bond payables are long-term liabilities. Did our bond payable go up or down? Bond payable went down, we paid it off. We axed it from the books. What does that mean for our cash?
Also went down.
Also went down. We had to pay for it we had to pay for it one way or another. Now, depreciation expense is very special because we count it in our income statement. Does it involve cash? Nope. We don't have to worry about depreciation expense taking our cash, but we mark it as an expense. Because of that, our net income is lower. So when we're talking about depreciation expense, we have to say, all right, our cash actually went up. We have to get rid of depreciation expense and bring up our cash. Because technically we didn't pay money. We just said, all right, this thing is worth a little less. Now, what if I got equipment, but I used a note payable? Is that involved in the cash flow statement at all? Nope. Because there's no cash handed. We just basically financed it with a liability. And even though it's a financing activity for a long-term liability to finance an investing activity, they axe each other off because there's no cash involved. When we're paying off that liability, that's when we start seeing it in the financing statement, the cash flow statement. But otherwise, we really don't have to worry about it. If you see something that's the kind of rule of thumb, 2 balance sheet items that aren't cash, axe it off. If you see it in income statement though, we have to deal with it. The income statement is where we start off in at points, because you start off with that net income and then you fix it with your reconciliation. But I think this is the basis that you guys need to know. I'm not going to get too far in intermediate 2 accounting, because I don't think any of you guys have to go through that. But any questions on operating, investing, or financing activities, cash flow statement, anything of that? Nope. Awesome. So I'm going to pull up the study guide. I'm going to do this for both. So, how are we feeling on chapter 1? Do you guys feel good of assets equaling liabilities and equity?
Sure. How about y'all?
And if anybody at any point says, hey, no, I need some help, even if the majority of us feel good about it, I'll still cover it, go over it. So, do you guys remember the accounting principles and concepts? The measurement principle, revenue recognition, expense recognition, the going concern, and the time period assumption.
I mean, if you wanna briefly
Be nice to have a
cover,
good quick review. Yeah,
So to briefly cover. I wanna make sure everyone is able to hear me. So. To briefly cover over. The measurement principle. Measurement principle is, okay, we're able to measure our funds. Because we're using cash. For example, I'm gonna pull back to kind of reference. Chapter 1 notes. Measurement principle, cost principle. Oh, never mind, I got it mixed up. I'm glad I came back to this. I'm thinking of the monetary unit assumption. The measurement principle is everything bought is at historic cost. If you buy something at the cost it is, it's set at that point. What does this usually apply to? Buildings. What else?
Land,
What was that?
land,
Yes. So plants as well. Cars. Any kind of long-term not liability, any long-term asset, even though it depreciates in value, that's why we have book value. So historic cost is very, very important for chapter rates. We have revenue recognition principle. That's where the moment we do a service, we record revenue. Doesn't matter if we got the cash or not. What does this usually apply to? We've done this a lot actually throughout the semester. Yes, when they owe you money later, so account receivable. And also when they pay you money up front. We don't record revenue when we get money in, we record what? Unearned revenue. Perfect. We got the expense recognition principle or matching principle. Again, that's the same thing as revenue recognition, except we're dealing with the expenses side of it. Where we say, all right, the moment that we pay for something, we have to record that it's expense. Or even if we don't pay for it right away, we still have to record an expense. Examples are like wages expense. When we do that adjusting entry of wages payable, wages expense, we owe our people money, welcome in. And we don't pay them till next week, but we have to record it in the time period we expense it in. We got the full disclosure principle, basically footnote, footnote, footnote. We tell you everything that's in our financials so that we have full transparency. The going concern, think of not concerned of leaving. It's basically assuming, hey, we're going to continue our operations. The monetary unit assumption, we're going to assume that we're using US dollars. This one's these two, the cons principle in the monetary unit, still get to me to this day. You guys see it yourself. So those two, you want to make sure you understand measurement principle, historic cost, monetary unit, we're using the dollar. Time period assumption, we have the lifespan of a business through the year. We're working with quarters, we're working monthly. It's just kind of that assumption. Some places they'll do the books quarterly. There's some places that do the books monthly. There's some places that do the books yearly, just basically time period assumption. And last is the business entity assumption. The owner is separate from the business. The owner's not going out buying cakes and cookies on the business credit card for his own baby shower or something like that. Any questions on any of those, or y'all feel good? Awesome. Nope, that's my stuff. So understand transactional analysis. Basically, know if assets go up, rather liabilities and equity go up or assets go down. That's kind of what we were going on the board there, where I was saying, all right, when inventory goes up, cash is going down because we paid for inventory, but that's a up and down effect in assets. Do you guys understand the financial statements? Can I get y'all to tell me what's the first financial statement we typically do? Income statement, perfect. What's the next one? Statement of retained earnings. The next one? Balance sheet, what's the last one? Statement of cash flows, perfect. What's the income statement? Perfect. What does it equal? Absolutely awesome. Awesome. So what's gonna be the statement of retained earnings? What was happening with dividends? Is that adding or subtracting? Perfect. And balance sheet, what are our temporary accounts? Expenses and revenues. There's one more type. Dividends, perfect. So, analyzing transactions, y'all understand the debit credit rules. Y'all know where your debits are, your credits, and what accounts go. Assets, debits or credits? Debit. Liabilities,
Credit.
credit, perfect. What about our expenses?
Debit.
Perfect. Revenues. Credit, perfect. And then equity. Okay, wait, welcome back. Sorry, my brain is, it's Sunday. All right, so know the normal balances, know how to record journal entries. The rules for journal entries. Can we have our debits not equal our credits? Nope, they always have to equal. If for some reason your debits don't equal your credits, you have a problem. Can we have one account? Nope. Can you have two accounts? Can we have more than two accounts? Absolutely. I bet we all have flashbacks back to chapter 10 with our interest payments, journal entries. So we ran through chapter 7 a bit already, but do you guys know how to record sales and cash collections? So when we're doing a credit sale, what's our debit, what's our credit? So someone bought merchandise off of us on credit. What's our debit?
Cash.
Nope. So I'm hearing a lot of different answers. When someone buys stuff on us off of credit, or we do a service for them and they haven't paid for their service yet. Account receivable. So it's not unearned revenue. Unearned revenue is when people give us cash and we have to say we owe them later. But when people buy a service off of us, we do the service. We're very good. We're on time. We mow their lawn, and then we go up to their doorstep and they'll say, "I'll pay you next week." That's an account receivable. They're going to owe us money later. So there's no cash involved. What's going to be our credit?
Revenue.
Revenue. Perfect. It's just revenue. So-
Because you did provide service.
This is our revenue recognition principle in action, where no matter what, we don't get the cash, but we know for a fact, I mowed that person's lawn. I sold that guy some Clorox wipes or something. Something has been transacted within action. It's just the promise to pay is for later. Unearned revenue is only used when someone gives us cash and we say, "Oh, right, we'll mow your lawn next week." We're the people that are dilly-dallying this whole transaction. So that's the only time when unearned revenue is done, is when we owe someone a service. In this case, we provided the service first. They owe us. Cash collections. So next week comes and the person we mowed the lawn for says, all right, here's your money. So how do we record us getting back our money? Credit or debit? Perfect. We debit cash. What are we crediting? Account receivable. They no longer owe us. We have to say, all right, thank you. Bill's been paid. That IOU you can rip up. Or I guess I'm going to rip up that IOU and we'll say everything's good. Then we got note receivable, which we kind of touched on it very little. The biggest thing with that is really just calculating that interest and maturity, which pull up a Google Doc real quick. Oh my goodness. This thing has way too many pop-ups for me. Okay. So to find your interest, you take your note receivable. Oh. Oh, that's fine. Okay. Let me bring it back over to the board real quick. So we got our note receivable value, which can be anything that we borrow. So 10,000. Multiply that by the percentage of interest. We'll say the interest is 6,000. So in total, that is about $600 of interest total. But you then multiply it because that's an annual percentage most likely. Then you multiply that by the number of days. So over 360 days, 360 is banker days.
It's just that I was wondering if you could make, I don't know, like the writing thicker because it's kind of hard to see.
Yeah, of course.
Thank you.
There you go. That should be a little bit better. So we got our note receivable. If it's 10,000, multiply that by 6% interest. And we'll say we got it for half of the year. So see 150, 180. So 180 over 360. I bet your interest in total is 300. But you just use that formula.
What's the formula for again?
Finding interest. This could work for note receivable. This could be used for note payable. Any short-term liability, this is the formula to figure out your interest. And then I'm gonna steal this back. Get rid of these study problems. All right. Chapter 4. Know the journal entries around purchasing and sale of inventory. How are y'all feeling on those? So do you guys want a refresher on those?
Don't want a very brief one, very quickly.
How about this? I'm gonna make a fill in the blank chart. And what I want you guys to do is in this fill in the blank chart, you guys are gonna write the journal entries because the journal entries are the important part. And then we'll do a quick problem based on those. So it'll be a cool little grid that you guys can keep in mind. Started on this while I'm writing it down. You have an idea of what to fill in the blank. Each box is gonna be a journal entry. Guys, just about 3 minutes. Do as much as you can and what you remember, and then we're just gonna run through it together. Remember too, this is all based upon paying things off of credit. So that's why we have the paid in discount and the paid without discount, because back in chapter 4, that's when we were focused on the journal entries for buying equipment and, not buying equipment, buying inventory and selling inventory. We're gonna start going through this. Anybody have a journal entry for being the buyer and buying inventory? What's our debit? Inventory, perfect. What's our credit? So, not cash. What's our account when we buy stuff off of credit?
I guess it's account payable.
Account payable. All right, shipping point FOB. Who's responsible for the shipping? The buyer or the seller?
The seller.
The buyer, actually. They gotta think about it this way. If we had a line here, this is shipping point, this is destination. It exchanges hands and destination, so that means the seller's responsible for all of this. While shipping point, the seller's only responsible for this, while the buyer is responsible for all of this. So because we're dealing with shipping point FOB is going to be who's taking the cake for buyer, so there's no journal entry for the seller. Now, what would be the journal entry for shipping point? I really just need the debit, the credit's going to be cash. But what increases in value because we had to pay more for it? Inventory. That book off of Amazon that I thought was $10 ended up being $15. I'm gonna tell everyone I got a $15 book instead of a $10 book because of that dang shipping. That's the best way to explain it. Destination FOB. So if a buyer has to take the shipping point for, if the buyer has to take the shipping price for shipping point, do you think they have to do anything for destination? Nope, they're sitting in an armchair relaxing. Destination FOB for seller. What's gonna be that journal entry? Shipping. Shipping expense, freight expense, any kind of expense. And cash. Perfect. Now we're dealing with returns for the buyer. We're still just focusing on the buyer. That just kind of bleeds over a little, so that's why we get a ping pong. But returns, when we return product, what's gonna be that journal entry? What's our debit? Not cash. They're not gonna give us cash because we haven't given them cash yet. Accounts payable. We decrease our account payable, because we owe less. What's our credit?
Inventory.
Inventory. Goodbye, inventory. We barely knew you. All right, if we paid within the discount period, what's our debit? What's credit? So what are we axing off? What are we getting rid of? Non-expense. So do we owe anybody anything once we pay it off? We're gonna debit account payable. Now, what do we credit? What's the easy one that we credit? Cash. But we are in the discount period, so what else do we credit? Huh? Not discount. What changes value because we paid less for it? Inventory. If you go over to the clearance aisle on HEB, you'll find things like wines that are $20. But sometimes they'll put some wines up there and they're $10. And so I'll go to my friends and say, hey guys, I found a really good bottle of wine for $10. So think of that for like outfits too. If you get a discounted dress or discounted shirt or discounted like really nice pants, when people are asking you how much it was, you usually say the discount price. That's how I think about this. So I don't know if that helps, but just little ideas. All right, paid about the discount. What happened? What's gonna be our debit? Account payable. What's our credit? Cash. Everything revolves around inventory. Anytime we're changing the value of inventory, it's because an action has changed the value of our inventory. We had to rather pay more for it, or we paid less for it, or we returned it. Either way, 90% of this is inventory. What I call about the seller though, the seller is focused on keeping the sales pure. So we have two journal entries for seller. I like to call them, we have the profit portion. And then we have the product person. So if we're focusing on profit, what's going to be our debit? Do we deal with cash when we're dealing with credit? Not yet. So. Our debit. Account receivable, perfect. What's going to be our credit? Huh? No, revenue. Think of it this way. Is the amount that we sold it for what we want to say it was valued at? If I bought I got this nice marker stick for $2. I sell it to you for $4. Am I gonna say this was worth $4? Or am I say it's gonna worth $2? The revenue part of it is where it's worth $4. That's why this is profit. Profit's focused on the credit that we use for the customer and the revenue we reported from it. Well, welcome. We got the sign-in sheet somewhere, so. We're running through chapter 4 right now. So this is where we work on the product portion. This is where we're really focused. We're focused on the profit, what I sold it at for profit, and product, what I had bought it at. So what's going to be our debit there? Cost of goods sold. What's our credit?
It's inventory, isn't it?
Inventory. Any questions so far throughout any of this? Or is this kind of making sense? We're getting reminded back of chapter 4 all those months ago. So we keep them separate. We also have another returns where again, we keep them separate because again, there is a profit portion and a product portion. We have to regain the inventory that we sold off that is now said to be defective. We'll figure that out one way or another, but we take in the return product and we have to deal with the profit portion too, because we can't just give them a discount. So, you guys wanna work on the profit or the product, journal entry first?
How about the profit one?
Profit? What's gonna be our debit? You wouldn't debit account receivable. This is profit portion. So if we're focused on keeping the sales pure, do we use a special account for this?
Yeah.
Do you guys remember what that special account is called? When people are returning products? Sales returns and allowances. I'm just gonna call it sales returns. What are we crediting? So we're marking that we have a returned. What do we credit?
No idea.
Account receivable. So you're correct, it was just for the opposite side. That account receivable, we credit it out. The reason why, do we want to say they owe us the same amount of money when they returned a product? Nope, we're gonna say, all right, thank you, we'll take that off your bill. So now we're working on the product portion. What's gonna be our debit? Inventory. What's gonna be our credit? Cost of goods sold, perfect. Now. Paid within discount period. What's gonna be our debit and what's gonna be our credit? Cash, debit or credit? Perfect. What other accounts we working with here?
I mean, I have no idea. Probably accounts receivable somewhere in here.
Would you think it's going up or down?
It's gotta be going down because we already received it.
Perfect. Then you put that as credit. Now we're just missing one piece because they paid within discount. So we said, all right, we'll give you a discount. What is that account called?
Is it like the other one where it's inventory or is it something else?
Something else. Because right now we don't care about inventory. Inventory left our warehouse. We're good. Is it contra? Well, think of it when they paid within a discount. What's that account for discounts? You guys can throw out random suggestions.
I don't have any of them that sound right, so.
Hey, even if it doesn't sound right, something you guys gotta learn in college career, throw out anything you say, because trust me, your brain tends to actually learn better when you, even if you answer things incorrectly. Little tidbit from when I was an education major.
Sales discount.
Sales discount.
Okay.
It'd be sales discount. Either way, it's the discount account, because again, we have to keep our sales pure. So just say it as it is. What about if they paid without the discount? Sorry, journal entry. Cash and account receivable. So those are all of our journal entries, and kind of to give you an idea of why we keep our sales pure. Does anybody remember the gross profit formula?
Was it revenue minus cost goods sold?
Close. It's net sales, technically. What make up net sales? I'll give you one. Sales starts. Not revenue minus expenses. Think of net income. But it's pretty close. So, a hint is it's within the sales column. Sales discount is one of them. Subtract or adding. Perfect. What else? Got one more. Not revenue. Inventory. Cost of goods sold is all about inventory. Returns. This is important because as a business owner, you want to be able to keep track of how much you made in total. Because this is our ideal number. This is how much we wanted to make this quarter by selling everything. This is what we could have had. This is our dream. Our sales is our dream. And then they get wrecked by the discounts we give to customers and the returns. So if, let's say, at the start I could have made $1 million, but I come down to gross profit, I only made $200,000. That's a lot of money that I suddenly don't have. So then I can trace it back to, okay, was it the cost of goods sold? Did we buy really expensive inventory? Is it the returns? Are we giving too many defective products? And then we have the discounts. Are people taking advantage of our discounts? And if so, should we maybe stop or should we keep going? That's kind of the idea behind why we separate everything so much. And I'm hoping that kind of getting that background helps, especially during like the tests, thinking about that, because it is kind of trying to keep track. So now after that's all said and done, I'm gonna put down a quick problem that's gonna utilize all of these. If anybody wants to take a picture of the full chart, or if you guys have your own, I'm gonna put a scenario, and just kind of like the LIFO FIFO, you guys are gonna make a journal entry for both the buyer and the seller for every scenario from each side. It's gonna look like one or the other, but just make a journal entry for both. First question's up. Once I finish the last one, you guys only get 5 minutes. There we go. Is it 5 minutes? Journal entries for the buyer and journal entries for the seller. I made this very vague because we're just kind of going over the more concepts of it. And also so we're able to keep good on time because we only have an hour left.
Yeah, question.
Yes,
So for the 2 units returned, are we looking from the perspective of the buyer, the seller, or both?
both. All of this is for both. That's why I've left it as vague as possible too. But you have all the information here. Just use those journal entries and what you have in mind.
That's a good question.
Yeah.
So for the 2 units returned, are we assuming that what we see on one applies for the whole list? Okay.
Oh, yeah.
Because if it didn't, that would be terrible.
Now, each one of these are different problems with their own information. Take what you want. No, they all revolve around the first starting bit of it. It's just, it's left vague for expediting this process. And that way we're just like talk about it, because the most important thing is understanding, okay, what's the recall for this? Give you guys one more minute. So. We're gonna put the buyer in red and we'll put the seller in blue. So we'll focus on the buyer first. What's the journal entry when we are buying something? So inventory and accounts payable? Perfect. What is the value of our inventory? 400, perfect. All right, now we're on to shipping. Shipping was $100. Who's taking the shipping? The buyer or the seller? Seller, actually, because we're dealing with destination, and destination, if we remember right. It changes hands here. Meaning that the seller is responsible for all of this, getting it over there. So, anything for the buyer. 2 units were returned. What's our journal entry? Not shipping. This is for 2 units returned. What's our debit? What's our credit? Account payable and inventory. How much? What was it? 80, perfect. All right. Now, when it's January 10th, is that within the discount period?
Yeah.
Yep. So they pay. So what's gonna be our journal entry?
Accounts payable,
How much?
400, or no, not.
So anyone has a number for account payable?
320.
320. Not 400 because we took out, if we made a T chart here, account payable. It's 400, but then we took out 80, making it 320. So this is where we get this number that we have to get rid of. Now, what's gonna be our credits?
You know, the cash has to be one of them.
Cash does have to be at one of them, but how much?
Well, it can't be the full thing because of the discount.
Mm-hmm.
The other one's in inventory.
The other one is inventory. So, how much is gonna be our discount for inventory?
I think it's 9.6, but I'm not sure.
Perfect. It's 9.6, we're gonna round up to 10. Make it easy. So does that leave us for cash?
It's 310.
310. Now, if we paid January 20th,
Accounts payable for 400, cash for 400.
not 100. You gotta remember, 320. Because of the fact that we return things here, it's permanently affecting that 400. So that's gonna be our buyer. Any questions on the buyer?
So question, remind me why it's like 400, because for some reason I put 40 and I don't know why.
Oh. 40 times 10.
10. Oh, I rewrote it as 1. I was freaking out because I was like, you don't even, do I know if I have the units? Because I saw 40 and then 80. I was like, oh
That's all good.
no. All right.
And I saw a hand in the back.
Yeah.
Where did the 10 in inventory? So. 1 second, let's deal. I'm still here. So, where did the 10 come in here? So, we take 320. Using paid in the discount period, so we have to figure out our discount. We take 3 over 15. Does anybody know what 3 over 15 means?
It's the 3, you get 3% discount if paid for 15 days.
Perfect. Because they paid the. So that's 9 days. We get that discount. So we take 320, multiply that by 3% or 0.03. That will give us 9.6. I put 9.9. 9.6, but we rounded it up to 10. Does that help out? Awesome. So, any other questions for the buyer before we go to the seller? Awesome. So, how many entries do we have for the seller when we're dealing with things being sold?
2.
Perfect, yeah, 2. So we got our profit and a product. What's gonna be the profit journal entry?
Accounts receivable for 400, revenue for 400.
Perfect. What's our product?
Cost of goods sold for 100, inventory for 100.
Perfect. How we found 100 out was by taking the cost per unit for the inventory and multiplying that by the 10. So $10 times 10, is 100. All right, shipping. We determined shipping is going to the seller. So what's gonna be our journal entry for shipping? Not inventory cash. Inventory cash is only if you're the buyer. We don't care about inventory the moment it leaves our warehouse.
Shipping expense.
Shipping expense of cash. Two units for return. How many journal entries? Two, perfect. Again, profit and product. What's our profit portion?
So profit's like the first one, so I think it's sales, returns and allowances.
Perfect.
We got 80 for that. And then we have accounts receivable that's gonna be credited, also 80.
All right, what's our product portion? Inventory, and which one? Perfect, how much? Perfect. All right. Now they paid January 10th, meaning there's that discount, so. What's the journal entry for this?
The 20 for cash.
So it cash be 320. 310.
310. Then accounts receivable and sales discount.
So sales discount, debit or credit?
Credit.
Debit,
Debit.
because you have to
Yeah.
add it back up to 320. Because accounts receivable, I don't think it's supposed to change.
Yep.
Because accounts payable didn't change either, so accounts receivable, if we're gonna like reverse this, it's.
Exactly, so. Account receivable, we went the whole kit and caboodle, everything has to equal up to it, I like to call these anchors. You're the one that determined how much. In this whole journal entry. Now, if they paid January 20th,
Then it's just cash 220 and receivable 320.
you guys see how everything kind of mirrors each other too? The only thing is, the product portion is very specific. For the seller, because only the seller really knows how much it costs for that inventory. If you think about it, whenever we go to like Walmart, Kmart, any of those marts, and we buy product, we don't know how much that costed the seller. We're only aware of how much it costed us. That's why we don't have to do any of these little entries here for the product. But when we go off and sell this inventory to someone else, then the cycle continues. Any questions on the seller part of this? Any questions on chapter 4 after this point? Nope. Good to hear. But that's chapter 4 in a nutshell. Yeah, what's the question?
So like. How like prevalent do you think it's gonna be on the exam, just like, what do you think?
I think most you're only really gonna have maybe 2 questions at most. And again, a lot of it's mostly theory, like you're gonna have to figure out some journal entries and stuff. If I remember right, it's mostly gonna be multiple choice. So understand your journal entries, understand like the basic concepts. That's gonna be the biggest thing. Like obviously, you're not gonna get 10 questions just off of chapter 7. It's more than likely you might see it twice. So a lot of this, if you have like a chapter, well, hopefully not 2, but like a chapter that you don't feel great on, at least you take comfort, it's most likely going to appear only like once or twice. The ones that are going to be really prevalent are chapter 1, chapter 2, and chapter 3, because those are the bread and butter of accounting. So if you don't feel great on chapter 1, 2, or 3, I really highly suggest going through it and just understanding those, because that's everything that accounting stands on. Everything else builds on that. So chapter 4, the multi-step income statement versus single step income statement. Basically, the multi-step takes that net sales, cost of goods sold, and gross profit, how to calculate gross profit, be able to classify account types and know which financial statements they would apply to. This is why we're talking about account receivables like that. Real quick, I wanna flop back over. I do wanna do, I know we talked about the sales discount and stuff like that, getting the net sales, the gross profit, but I do want to take this problem and actually work on that point of it. So first things first, what's our net sales? So, and we're gonna ignore the before discount period. We're just gonna focus on if they paid within the discount, what's gonna be our net sales? So first things first, how do we figure out our net sales?
Sales minus discounts. Returns. So how much was our sales in total? 100,
Not 100,
no, 400.
400. What was our discount?
10.
What's our returns?
Easy.
80. So our net sale in total is 310. How about our cost of goods sold? How much was our cost of goods sold? 80. What does that mean for gross profit? $230. So, again, this is why this is so important to keep sales pure as a seller. Because now we're able to see, all right, we could have made $400, but instead we made 230. A little bit of a jump. There's a lot of things that went through that mess. But any questions on sales I'm not supposed to get discount, the gross profit formula? All right, good to hear. All right. Chapter 5, we went through that. We got LIFO and FIFO. Perpetual versus periodic. Periodic is the theories behind periodic and perpetual. Perpetual, we're always counting inventory. Periodic, we'll check it when we get there. So just knowing that. Comparison of inventory methods. So anyone that came in after we kind of worked through chapter 5, again, I'm going to post this after, but since we've kind of covered it a little bit, we're just going to keep going. Chapter 8, how do we feel about chapter 8? The fixed assets, being able to calculate straight line depreciation and gains and loss of assets. Or do you guys want to work a little bit on that? I'm gonna take the silence as you guys know it. So if you guys want me to go through it, let me know. Yeah. Brief overview. I'm gonna highlight this. So, brief overview. So I'm gonna give you guys 5 minutes on this problem, the moment I put the first question up there. So when I put the first question up there, start working on this problem. And then in 5 minutes, we're gonna work through it.
What type of question is this?
Chapter 8, depreciate.
All
We're
right,
gonna go through the depreciation for a year and we're also gonna sell the asset.
okay.
All right, questions up, find appreciation for the first year and write the journal entry. A little bit more, so I'll give you guys like 1 extra minute, at 4:28. We'll start working through this.
That's like, we're calculating depreciation for 1 whole year.
Yes, so each one is gonna be your journal entry. So make a journal entry for year 1 and year 2. And then the book value is gonna be for year 4. And then we're selling it year 5.
And so for the book value, is that just a numerical value?
Yep.
Okay.
So that's just figuring out, and best thing to do is write out the whole equation for it, but yes.
So the year 5 question, are
Mhm.
we assuming that we're at the end of year 5 or the beginning of year 5?
Just think year 5. So don't worry about the beginning of end, just worry about how much accumulated appreciation for year 5.
Because I would think that by the time year 5 is done, it would be 2,500, but if we're looking at year 4, then it's 2,000.
Nope, just worry about year 5. So you're right with the first number.
So where's 2,500 on the,
These are all what we sold it for. So this is how much money people have given us for it. So these are 3 different answers for journal entries on when we sell the asset. So in one question, we sold it for 1,500 cash. Another question, it's $1,000 cash. The other question, it's $2,000 cash. So 3 different journal entries, 3 different scenarios.
oh, okay. So it's not related to the first question at all.
It is related, but it's not gonna be dependent, like completely, well, it's dependent on it, for a piece of the fact. Okay. Because to sell an asset, ignoring the gain or loss, what do you have to debit? What do you have to credit? You guys got 1 more minute on the clock. All right. We're getting started. Depreciation journal entry year 1. What's our journal entry? Depreciation expense. Perfect. Now, what's the number we're putting up here? 500. Now, what about year 2? 500, same thing. So year 1 and year 2 will have that same journal entry. Now, what's going to be the book value year 4? 2,000. Take your cost of the asset. Take your accumulated depreciation out, which by year 4 is 2,000, because we have our accumulated depreciation here. Here's year 1, here's year 2, here's year 3, here's year 4. Carved out. 2,000. So. In year 5, we sold the printer for cash. I have 3 scenarios up here for 3 different cash values we got. So first things first, for number 1, what's the journal entry? That's depreciation expense. Cash. How much? Huh? 1,500. All right. What's gonna be our next account?
I have some guesses as to how this might actually be done.
All right.
So I decided to put accumulated depreciation as a credit of 2,500, and then I was like, okay, what if we put book value on the debit?
You want to
That's-
use book value. Book value is not an account. So you had a bit of an answer too.
No.
No?
I've never-
Oh, okay.
I don't, this chapter is horrible.
Awesome.
Yeah.
Yeah, we all have our.
It's-
yeah,
it's
I
so
just-
fun.
Like depreciation account. Totally over.
All good. So. Book value is not an account, but accumulated depreciation is.
What
So
would the account name be then? Because I know that there's like a discrepancy between like the accumulated depreciation and like
So-
the cash.
let's go back to when we bought the asset. So what was the journal entry to buy the asset? Huh? Not gains.
It's like bad debt expense.
Nope, that's chapter 7 and that's with account receivable. So you don't have to worry about that with equipment. So when we buy a piece of equipment, what's our debit? What's our credit?
Wait, didn't we have depreciation expense somewhere in there?
Nope. Depreciation expense is only seen here.
Like chapter 8.
What was that? Not supplies. Supplies, we use them in the year. So those are current assets. This is a long-term asset. Just printer, equipment.
Oh, because it's the thing, it's the value that the thing has left. Right?
And then we have cash, paper and cash. So book value is the value of it, but these are two different accounts. Book value is kind of a equation. So it's kind of like net realizable value. It's just so we can condense our balance sheet. So now we have our printer on the books and we have to get rid of it. If we debit our printer to gain it, how do we get rid of it? Right. $4,000. Because the measurement principle says historic costs.
Ooh,
That's where this ties into.
oh, I see.
Now, what other accounts are we using?
Accumulated depreciation.
Accumulated depreciation, how much?
Debit.
Perfect.
So then that goes as a debt. Okay, yeah.
So- Are we done with this?
Yep.
Yep. We basically broke even. We said, all right, 1 for 1. We didn't have to worry about a gain or a loss. Now, number 2. What's our debit? What's our credit?
This one,
Same thing.
just different amounts.
So accumulated depreciation and printer stay the same throughout all of these. Because no matter what, they're not changing. What is changing is cash. So cash in this equation is 1,000. Are we done here? Nope. What's off?
Earnings.
Yep. So do we have a gain or a loss here? Loss. Loss of how much? 500. And once again, our journal entry does not change for number 3. But our cash does. We get $2,000 now. So do we report a gain or loss? Got a gain. Any questions on any of this? Now, we have depreciation. Yes,
So the 500 is from. Where is the 500 from the depreciation?
from straight line depreciation, so we have 4,000 minus 500 divided by 7.
Okay, I was making sure it came from there. I was looking at it weird.
But it's always good, like I said, I'm recording this too, so if anybody coming back here is wondering, hey, what the heck, how did that happen? We got it. Yes. So it's adding 500, so just like how we have here, where we find that AV amount from that book value, we'll make an AV chart. I'll say, all right, year 1, 500. Year 2, 500. Year 3, 500. 4, 500. 5, 500. Add them up together. 2,500. Gain is credited because think of this revenue. Revenue is credited. And we're making a gain here, so it's credit. And loss, I like to say loss is like expense. It's on the side of expenses or loss is left. Does that make sense? How did we what? Have a loss? Because if we add this together, so we know after year 5, our book value, we have 4,000 minus 2,500 is 1,500. So that's our book value. And number 1, we broke even because 1,500 equals 1,500. And situation 2, we got $1,000 in cash. Well, this thing is valued on the books for 1,500, but if we got $1,000 in cash, that doesn't cover all of what we're getting rid of. So because we got $500 less than what we value the machine as, we take a loss. So that's minus 500. Over here with 2,000, that's 500 more than 1,500. So we have addition of 500. Does that make sense? Awesome. Any other questions? So, what is not depreciable? There's one asset that is not depreciable in our long-term assets.
Land.
Land. So it can't depreciate land. We hope it stays here for a very long time. Everything else is fair game. Now, depreciation is with buildings, it's with equipment, it's with land improvements, which are not land. Remember, land improvements are like our fences, there are paved ways, there are roads. Now, we also have things like depletion. What is depletion tied to? Natural resources, oil, gas, things of that nature. What about amortization?
Repeat the question, I didn't hear anything.
Oh, so basically, what is amortization with? Because we have depreciation is with equipment, buildings and stuff. That's how we depreciate things. Depletion is when we're depreciating based off of natural resources. So we're depleting the natural resources. So that's like our coal mines, our our gas mills and all that. Now when we're dealing with amortization, what is that tied to? Intangible assets. So intangible assets are
Right. Franchises, goodwill.
trademark, all that fun stuff. So, any questions on any of those? Awesome. So we got 20 minutes. Let's pick one last chapter to focus on. And after that, y'all are free to mill about and get ready for tomorrow. So we have chapter 6. Just know your theories. That one I can go real fast on. Internal controls. Basically, we're trying to make sure that we're able to prevent fraud, human error, things like that. One of the big things is doing bank reconciliations. So comparing our bank and book balances. And let's see. I'm trying to think of anything else, but really it is mostly internal controls. You all know the fraud triangle, right? What's the fraud triangle? So one side is pressure. I was pressured to do it. I had to make enough money for my family, so I stole the $5,000 from my employer. The next one is, I got y'all started. Any certain come to your mind? Opportunity. Perfect. I had the opportunity for it. It was right there on the table. No one was watching. Last one. Rationalization. I earned this money. They don't pay me enough for this.
You can just look it up now.
Yep. Rationalization, pressure, and opportunity. So we got current liabilities and long-term liabilities. We don't need to do amortization or early retirement of bonds. We just really have to focus on, okay, our liabilities. We know what our current liabilities are. We should know what our long-term liabilities are. How do you guys feel about bond payables, their contract versus market rate, their percentage and stuff like that? Or do you guys want to go over that a little? Go over that?
Oh, dealer. I think it's saying that.
Oh, dealer?
No, I forgot, I can't find it.
You're good. So dealer is to focus on debits and credits. I like to call it a little guideline. Did I take all of my pens? I did. Basically, everything on the left, their normal balance is a debit. Everything to the right, their normal balance is a credit. So if you think about it, when we're dealing with revenues, if our revenues are increasing, we credit them. If we're dealing with expenses, if our expenses are increasing, we debit them, and vice versa. If our liabilities are decreasing, we debit them. And this is in the form of a T-chart. T-charts are fantastic.
Go over stocks issued.
Stock issues. So, do you guys want to go over chapter 10 or chapter 11? Because I don't know if we're gonna have enough time for both.
I'm just worried about like par and journal entries.
Par and journal entries. Basically, par value, so like with common stock. The par is always gonna be what it is called, so like $6 par. It's going to be different than what they're sold at. So this, our debit would be cash. For 10, because we're just saying we sold one. Our credit would be common stock, which would be 6. And our PIK account would be 4. Now, as we increase, so let's say if we sold, so that's one stock. Now, if we sold, someone give me a number, any number. 8. So now we sold 8 stock. Everything is multiplied at that point by 8. We got cash for 80. Common stock for 48. And we have the PIK account at 32. That's all it is.
What is the
It's basically a plug account. It's paid in capital, so it's excess.
Okay.
So
That's pick common stock.
yeah, PIK.
Please zoom this in. Thank you.
No problem.
so if you no, so par is what it's
Par is the value of the common stock. So this common stock will always be $6 par. So it wouldn't change. So if the next question I said was, okay, we sold it at 11, if I gave you no other information, you just assume, all right, $6 par.
I believe for the PIK account, the teacher likes typically like us to remember the specific type that is,
Yeah.
in this case, common stock. If it were like treasury stock, we would have TS at the end. Though that's not really applicable since it's a multiple choice, but it's just good to know.
less.
Thank you.
I remember this a little bit better because it was more recent.
Yeah, so I'm going to go over the notes for chapter 10, then write out a problem, because I feel like that's gonna be easier. Yes, I know it's recorded. I'm recording it. So to kind of go over bonds, and I know this is blank notes, but the biggest thing to know about bonds is here. We got the contract rate versus the market rate. Basically, if they're equal, they're at par. Where's my marker? You'll have to bear with me. my terrible handwriting. Now, if the contract rate is less than the market rate, what is that? Discount. If it's higher than the market rate, premium. Now, when we're trying to figure out these questions, actually, I'm gonna actually go to the I am gonna go to the vibe board for the because that's gonna kill my hand, and I don't think you guys are gonna be able to read my handwriting going on a mouse. So when we're trying to figure out, okay, what is our premium or our discount? There's multiple ways to see it. One is when the question says, all right, the bond. So you know the bond itself here is 100,000, but we sold it for 107,000. What does that tell us? Premium or discount? Premium. If it was 97,000. Discount. Other way is if instead of being told this, we were given 107. You guys know what 107 is? It's 107%. So because it's 107, is that a premium or a discount? Premium. You would take 100,000 times 107, which is actually 1.07, because technically this is the percentage. And you get alternatively too, if this was 97, discount or premium. Discount. And again, that's 97%. It's not going to give you the percent, but it's going to be a percent. Again, 100,000. 97.97. 97. And I don't think you guys have questions where it's giving you just the percentages, but whenever we're seeing these questions and you're getting, okay, it's 10%. 10%, our rate. Versus 8% market rate. One of these is to find the cash, which is our rate. The other one's to find the interest. To find the cash payment, it's going to always be the bond payable times the contract rate equals cash. The CD or the current, not current value. Why am I blanking on those words?
Blinking out too.
It's okay. We have the internet.
What is BFP?
B/P is bond payable. Ask me questions if there's something you guys don't understand. Please, please, please let me know, because the point of this is to help y'all get through this last exam. No, there's no question there's no stupid question. Carrying value, that's it. They take your carrying value, times that by your market rate, equals your interest. We have just enough time. I'm going to take a problem. And I'm gonna show you what I mean for this. You guys don't have to make an amortization chart, but just to show you, okay, interest payment for the first year. And you guys know my annual versus monthly, right?
CR is cash rate. Really.
Huh?
So what is CR?
Oh, contract rate.
Contract rate.
So. If. On. Thousand. Or we'll make this easy. We'll just keep to that 107,000. Contract rate of. Then. Wait, that one makes sense. So, this is our bond payable. This would be our current carrying value. Our carrying value changes because our carrying value is going to be kind of just like we did before with book value and with net realizable value. Our carrying value is always going to be our bond payable plus or minus our premium or discount. Equals the carrying value. Discount minuses, premiums add. So in this case, our bond payable would be 100,000. Our premium would be 7,000, so we add it, carrying value, 107,000. I'm sorry, I'm kind of like rambling through this. I'm trying to make sure I can throw all the best information at you for this last 5 minutes. To issue the bond, you get cash of 107,000. Because that's where we got here. Our premium would be 7,000. Our bond payable would be 100,000. Our interest payment would always be a debit to interest payable. Interest expense. Premium, in this case, it's premium. If it was a discount, it'd be a credit for a discount, not to be cash. How to find cash would be that 100,000 times 10%, which equals, I think, 1,000. My brain is going way too fast, so bear with me. 10,000. So cash is 10,000. We got a really heavy bond here. We got this from our bond payable. We got this from our 10% here. We're saying this, oh, we're not saying this is a triangle. We are saying this is annual. If this was semi-annual, what would we be timesing it by? Not 2.
6 months.
It wouldn't be 6 months. So we would, if it was semi-annual, we'd split this in half and say 5%. Because it is sick, we're only doing it for half of the year, so you divide it by 2. But in this case, we're just keeping it simple, we're keeping it annual. So that's our 10%. We then figure out our interest expense, which is 107 times that by 8%. Which is 8,560. Any ideas on how to find our premium? Make up the difference. 10,000 minus 8,560 equals 1,440. And if we are to retire the bond, it is the simplest answer. Bond payable, 100,000. Cash, 100,000. Enough our hands. That's it. Thank you all for joining. Is there any last minute questions that we just throw out there? You guys feel good? I'm gonna be posting this up tonight. But if you guys want to look at anything else, I have the review from last year up on YouTube. We have all the group sessions minus one exam session from this year. So we have a lot of different videos if that helps. You guys should still have your study guides from that I give you out throughout the year, if that helps. And all the blue kits. I sent out all the blue kits, I think Friday. Thank you. Y'all have a good one, guys.
Thank you.
Here, I could figure that out for you.
I don't know when any of my exams are. I haven't even looked at the schedule yet.